we've seen various large American banks, turning bullish on gold. I mean, Jamie Dimon said he wouldn't be surprised if it went between 5,000 and 10,000. You had Morgan Stanley saying, you should put 20% of your portfolio into gold, which actually is an extraordinary statement. The more it rises, the more demand it creates and the lower the supply becomes. In other words, it's a complete reverse, if you like, of market theory that rising prices will, release more product.
In a recent discussion, Alasdair Macleod, a veteran economist and head of research at GoldMoney, shared his insights on the growing bullish sentiment toward gold among major U.S. financial institutions. He noted that several large American banks have shifted their tone on the precious metal, with prominent figures such as Jamie Dimon suggesting gold could reach anywhere between $5,000 and $10,000 per ounce. Similarly, analysts at Morgan Stanley have gone as far as recommending that investors allocate up to 20% of their portfolios to gold, a strikingly bold stance from a mainstream financial institution. Macleod explained that what makes this rally unusual is its self-reinforcing nature. Traditionally, rising prices in a commodity market attract more supply and eventually temper further increases. However, gold seems to operate differently. As its price climbs, investor demand intensifies rather than cools, while available supply continues to tighten. This creates a feedback loop. Higher prices generate greater demand, and restricted supply amplifies the movement. He emphasized that this dynamic highlights gold's unique role not merely as a commodity, but as a monetary asset and safe haven amid global financial uncertainty. If you found this insight valuable, don't forget to like, share, and subscribe for more updates on global markets and precious metals.
And with gold, there's something interesting there too, because we don't have the backwardations between the spot and the futures market. Seems to be quite normal. I think that the bullion banks are trading that reasonably successfully. I think they probably welcome the uptick in business. They will be losing a bit on their positions on a mark-to-market basis, but they will be making lots and lots of money dealing, I think. But the problem I think the gold market has is that following the fiasco earlier this year, whereby the Bank of England was exporting gold out of its vault as quickly as it could, I think the central bank customers, because it's mainly central bank gold going out on lease, I think they would probably question the wisdom of leasing, because in the past it was leased and it would sit in the Bank of England's vault. Okay, it goes round and round and round, being hypothecated, rehypothecated, rehypothecated, and all the rest of it. But at least it was in the vault, and you knew it wasn't going to go anywhere by the end of the lease. Now it's gone. It's gone. So where's it gone? Am I going to get my gold back?
Yeah.
I think this means that central banks would be withdrawing from the leasing game. And that, I think, is where the squeeze comes in gold. We don't see it in prices yet, but I think that's probably why the price is rising. I'm looking at it just purely in market terms. This is why the price is rising. It's been rising so steeply because the system knows that it doesn't have the supply of physical, which has come through leasing, if you like. I mean, the lease rates haven't jumped or anything like that. It's just that, we know that we've got to get this price up in order. I mean, this is a sort of collective, if you like, view. We've got to get the price up simply because of the lack of leasing coming on. I mean, what's leased is leased at the moment, but leases aren't necessarily going to be renewed. So that does mean that there's going to be tightness in the market. And consequently, these prices are going up. And I think that's the way the market makers look at it. You've got to understand what gold and silver are, I mean, particularly gold in the current context, what it is. You've got to understand that it is legal money without counterparty risk. Forget what the US Treasury says about gold being a pet rock or whatever. The reality is that in our common law and in everyone's common law, gold is money, it's final settlement. There is no counterparty risk. And the volatility isn't so much in gold. I mean, obviously there's been volatility in gold, but it's mainly in the currencies. So when you see, for example, the People's Bank of China buying gold, the way to look at it is actually they're selling dollars. And they have other use for those funds. But basically they don't want dollars. So that's, if you like, the sort of their gold purchases are almost the small change, which they haven't got any other use for because they've got quite enough gold. I mean, not not necessarily within their reserves, but the nation has lots of gold spread around various accounts, including the People's Liberation Army, the Communist Youth Wing, and so on and so on and so on. So that's the way to look at it. So you've got to think, okay, do I buy gold because I think that paper currencies are going to lose purchasing power? If you think that, then the answer is yes, and you hold it, you hoard it. But people who have hoarded silver are either in two categories. They're either industrial users, and they're not going to sell their physical into the market, or they are investors. Now, there are various estimates out there as to how much silver is being held by investors. I've heard numbers of sort of 2 billion, 3 billion ounces. I don't know. I don't think it's nearly as much as that. I think all you can do is look at the stocks in COMEX and look at the stocks in London, and perhaps pencil in a figure for something in Switzerland. The rest of it, I think, we'd rather ignore, because the idea that you've got these investors, if you like, in places like China and all the rest of it, are likely to sell their stuff. I mean, if they sell it, you'll probably circulate within the country rather than come onto the general market. I think that these people are increasingly concerned that if they do sell their silver, they're not going to get it back. And the reason I think that they are feeling that is that if you have hoarded silver, or indeed gold, and to a lesser extent platinum group metals, you are obviously taking a view that the purchasing power of the dollar or your own currency is declining. And we have seen enough evidence that this is now happening, perhaps at an accelerating rate. I mean, you don't need to be a sort of wonderful economist. You just have to have a look at, what Trump's doing, and you sort of think, this is capricious, it's destabilizing, the whole thing. You see the geopolitical situation and so on and so forth. I think the answer is you hang on to your silver. I think that's what people will do. And I think that's what has really resulted in the squeeze in the market. I mean, you look at the stocks, in the vaults in the LBMA. I can't remember exactly what the figures are, but people try and make a guess about liquidity, and it's pretty minor. It really is. If someone told me that there was a coordinated move to basically bash gold and silver, and also platinum group metals lower, I could believe it. I really could, because what they would want, it's not that they're anti-gold or silver, it's just they want to get their position square. And I think this is a desperate attempt to just do that. Let's try and, get our bears closed a bit, and then at least, we can trade it at a higher level. I think that's all. That's what's going on, if you like, in London and New York.
In a detailed discussion on current gold dynamics, Alasdair Macleod shed light on the complex forces driving recent price movements. He noted that despite the absence of backwardation between spot and futures markets, bullion banks are handling trading activity efficiently, benefiting from increased volumes even if their mark-to-market positions suffer short-term losses. However, Macleod highlighted a deeper issue stemming from earlier this year, when the Bank of England was seen exporting gold rapidly from its vaults. Much of this was central bank gold on lease, and the event has made many central banks question the prudence of leasing their reserves. Previously, leased gold remained within the vault system, merely circulating through layers of hypothecation. Now, with physical gold leaving the vaults entirely, there's growing concern over whether leased gold will ever return. This retreat from leasing is tightening physical supply in the market, contributing to rising prices. Macleod explained that gold's role as true money without counterparty risk remains fundamental, a store of value amid depreciating currencies and growing geopolitical uncertainty. Investors and nations alike, he suggested, are recognizing that holding gold offers stability when fiat systems appear increasingly fragile. Let's get into the interview.
The central bank community, particularly in the global south, BRICS and so on and so forth, they can see what China is doing. I mean, with the SGE opening vaults in Hong Kong and also Saudi Arabia, and there are probably plans for other ones, or certainly facilities elsewhere, whereby gold can be exchanged for yuan. This is setting up a system which will allow the Chinese, if it is necessary, to protect the yuan's value by turning it into a gold substitute. But that would be at the international trade level. The idea that individuals in China would be allowed to, have a gold exchange, if you like, for their yuan. I mean, I don't see that at all. The authorities in China, I think, are all about hanging on to what they've got. They don't really want to part with it. And I think it would be a mistake to sort of think that, the Chinese authorities, whether we're talking about PBOC's reserves or whether we're talking about the hidden holdings, sort of spread around the various communist organizations, government organizations, I don't really see that they will be feeding this new vaulting system outside China. I think they're going to still hang on to their gold. But I think what they will do is they'll say, well, what you could do is you could acquire some gold, put it in that vault. You could exchange it for yuan when it comes to trade settling and all the rest of it, so that you foreign country, have the facility to trade in a gold-backed yuan. They will set the rate at some stage. I think that's inevitably what's going to happen. And it doesn't really require China to part with some of its gold, maybe a small amount. But I mean, basically, I think the idea is to make the yuan, if you like, the dollar's replacement. And this one will be a lot more secure than the dollar. I think that's the important thing. And as the dollar declines, I mean, we're coming to, there's no doubt in my mind that we're coming to the end of the fiat currency system. The Chinese, I think, are perfectly aware of this. And they want to protect their currency. They want to protect, their position. And they don't want other currencies, for goodness sake. I mean, if the dollar goes down, what happens to the other currencies? They go with it. It's as simple as that. So they will want to trade in their own currency. Of that, I'm absolutely convinced. And they will want to protect the value of their currency. But the important thing is that the stock market has taken off everywhere. We are now about to enter the third phase. And the key to it will be to understand the moment the credit bubble bursts, because the whole thing has been driven by a credit bubble. If you look at lending to stock investors, I mean, the level of margin loans is now $1.2 trillion. And that backs roughly $3 to $4 trillion worth of stock. This is, I tell you, this bubble is the biggest ever. And if you want a psychological marker, the rise of Bitcoin is rather like your tulip mania, but without the bulbs. I mean, I know you did jolly well out of Bitcoin in the early days, but it is not legal money. And, these hodlers who are sort of so keen to think it's the money of tomorrow rather than all the rest of it, got no legal status whatsoever as that.
In his concluding remarks, Alasdair Macleod explored how the global financial landscape is evolving as China quietly builds an alternative to the Western-dominated monetary system. He pointed out that with the Shanghai Gold Exchange expanding vaults in Hong Kong and Saudi Arabia, and potentially elsewhere, Beijing is laying the groundwork for gold to play a direct role in international trade settlement. This would allow other nations to exchange gold for yuan, effectively creating a gold-linked trade currency without China having to part with much of its own reserves. According to Macleod, this move positions the yuan as a potential replacement for the US dollar, backed by tangible value rather than debt. As fiat currencies weaken and the dollar loses dominance, China appears intent on safeguarding its monetary sovereignty. He warned that the current global stock market boom, driven by excessive leverage and credit expansion, may be approaching its breaking point. A bubble of historic proportions. In contrast to speculative assets like Bitcoin, he reaffirmed gold's enduring role as real money. Legal, final, and without counterparty risk. The world he suggested is on the cusp of a monetary realignment. Like, subscribe, and comment below to share your thoughts on this unfolding shift.